As we are in October, it looks like they're slowly re-entering the market once again. Findings originally uploaded on Twitter on the 18th of September by analytics account Bitcoin Data 21 show one crypto app in particular is making a comeback. I'm certain you'll never be able to figure it out.
Welcome back, everyone. Bitcoin is back in the spotlight, and with prices on the rise, retail investors are rushing back into the game. But here's the burning question. Are they about to make the same mistakes we've seen over and over again? In this video, I'm going to break down why retail investors often lose out in the crypto market, how the big players, whales, are positioning themselves, and most importantly, what you can do to avoid falling into the same trap. If you're serious about maximizing your gains and protecting your portfolio, stay tuned, because this is a lesson you can't afford to miss. But before we dive in, don't forget to like, subscribe, and hit that notification bell so you never miss another update in the fast-paced world of cryptocurrency. Every click helps you stay one step ahead of the market, and let's be real, who doesn't want that? We've been witnessing some fascinating trends in the cryptocurrency market over the past few weeks, trends that have sparked excitement, curiosity, and even a bit of anxiety. After months of stagnation, the crypto space is experiencing a resurgence. Bitcoin is back in the headlines, prices are climbing, and retail investors, after sitting on the sidelines for most of the year, are once again pouring into the market. But here's the catch. Many of these investors are following a well-trodden path, and not always to their benefit. So why does this cycle repeat itself? Why do retail investors seem to lose out time and time again? More importantly, how can you, as an individual investor, avoid these common pitfalls and position yourself for long-term success? To understand the current landscape, let's rewind a bit. For those of you who were paying attention during the summer of 2024, you'll remember that the market was relatively quiet. Bitcoin's price had dipped, and so had interest. Retail traders, spooked by the downturn, were quick to sell off their holdings.
It says Bitcoin is regaining popularity among retail traders after months of absence. This is according to new data. Every time this was basically the summer, if you don't remember. Every time that prices went down, the only people who were selling were retail investors. It was the same over and over. Everyday normal people who would or could benefit the most from actually buying and holding crypto, they sold off the quickest every single time.
What made this particularly surprising was that many of these investors stood to benefit the most from holding their positions for the long term. Instead, they fell victim to panic selling, a phenomenon that's all too common in the world of cryptocurrency. This behavior isn't unique to 2024, though. It's a pattern that we've seen time and time again in the crypto space. When prices rise, retail investors rush in, eager to catch the wave. But the moment the market turns bearish, they flee, often at a loss, expecting prices to continue falling. It's an emotionally driven cycle that has cost many investors significant returns over the years. But now, as we move deeper into October, there's been a noticeable shift in sentiment. Bitcoin is regaining popularity among retail traders, and the market is showing signs of life once again. According to recent data, retail interest is on the rise, and Bitcoin's price is reflecting that renewed enthusiasm. To better understand why retail investors often lose out in crypto, we need to dig into the psychology of market behavior. Investing at its core is about managing risk and reward. But for many retail traders, emotions, specifically fear and greed, play a much larger role than they should. Let's break this down. Number 1, fear of missing out. FOMO. When Bitcoin's price starts to rise, retail investors often experience FOMO, or the fear of missing out. They see the headlines, they hear the success stories, and they rush into the market, often without doing proper research or understanding the underlying technology. This is particularly common during bull markets, when prices are climbing rapidly and it seems like everyone is making money. But this is where many make their first mistake. They're buying in at the top when prices are inflated, rather than during the quieter periods when prices are lower. Number 2, panic selling. during downturns. On the flip side, when the market takes a turn for the worse, fear sets in. Retail investors who may have overextended themselves or who don't fully understand the volatility of the market panic sell at the first sign of trouble. This often happens after they've already suffered some losses, leading to a sell-off at the worst possible time. Instead of holding through the dips, they cut their losses and exit the market, missing out on the eventual recovery. Number 3, trying to time the market. One of the biggest mistakes retail investors make is trying to time the market. They think they can predict the perfect time to buy and sell, but the reality is that market timing is incredibly difficult, even for seasoned professionals. More often than not, retail traders end up buying high and selling low, the exact opposite of what they should be doing. Number 4, lack of a long-term strategy. Many retail investors enter the crypto market without a clear plan. They're focused on short-term gains rather than long-term growth. This lack of a strategy leaves them vulnerable to the emotional highs and lows of the market. Successful investors, on the other hand, have a clear strategy in place. They understand their risk tolerance, they have a plan for both bull and bear markets, and they stick to their strategy even when the market gets volatile. Now let's fast forward to today. According to recent data, Bitcoin is once again gaining popularity among retail traders. Findings posted by Bitcoin Data 21 on Twitter reveal that the Coinbase app, one of the largest cryptocurrency exchanges in the US, is seeing a significant uptick in downloads. The chart they shared shows that Coinbase is consistently ranked among the top 500 most downloaded apps, a significant metric when you consider how many apps exist in the marketplace. But here's the interesting part. When you dig deeper into the data, you'll notice a strong correlation between Coinbase downloads and Bitcoin's price performance. When Bitcoin's price rises, so do Coinbase's downloads, as more retail investors jump back into the market. It's a pattern that we've seen before, and it suggests that retail investors are once again entering the market after months of sitting on the sidelines. During the last bull market, Coinbase reached as high as the top 175 most downloaded apps. But when the market turned bearish, interest waned and the app dropped below the 500th mark. Now, as Bitcoin's price hovers around $60,000, we're seeing a resurgence of retail interest. But as history has shown, the question remains, are these investors too late to the party once again? Retail traders may not be the biggest players in the market, but they still have a significant impact on Bitcoin's price. Every time they re-enter the market, they're adding liquidity, buying up Bitcoin and, in the process, taking it off the market. If 10,000 people download Coinbase and buy $100 worth of Bitcoin each day, that's a substantial amount of Bitcoin being purchased. However, retail activity alone doesn't tell the full story. The cryptocurrency market is influenced by much more than just retail investors. Institutional players, whales, and even global economic events all play a role in shaping Bitcoin's price. The challenge for retail investors is that they're often reacting to price movements rather than anticipating them. By the time they've entered the market, the big players have already positioned themselves, taking advantage of lower prices and preparing for the next move. While retail traders are often driven by emotions, whales, those with large amounts of Bitcoin, take a more calculated approach. They understand the cyclical nature of the market, and they use this knowledge to their advantage. During price dips, whales are quietly accumulating more Bitcoin, taking advantage of the panic selling by retail investors. Data from blockchain analysis firms shows that wallets holding large amounts of Bitcoin have steadily grown during market downturns. In contrast, smaller wallets, typically owned by retail investors, often see outflows during these periods. This suggests that the big players see these dips as buying opportunities, while retail investors are selling out of fear. To understand why retail investors often lose out, it's important to grasp the psychology behind market cycles. Markets, including cryptocurrency, move in cycles. Bull markets, where prices rise, and bear markets, where prices decline. These cycles are driven by a combination of factors, including investor sentiment, economic conditions, and technological developments. During bull markets, optimism is high, and prices can rise rapidly as more and more investors pour into the market. This is often when retail investors get involved. driven by FOMO and the desire to capitalize on the upward momentum. But bull markets don't last forever. Eventually, the market reaches a peak and prices begin to decline. This is when the fear sets in, leading to panic selling and a rush to the exits. Bear markets, on the other hand, are characterized by pessimism and fear. Prices decline, often sharply, and many investors, particularly retail traders, exit the market. But for those who understand the cyclical nature of markets, bear markets are an opportunity. They allow savvy investors to accumulate assets at lower prices, positioning themselves for the next bull run. Let's take a look at some past cycles to see how this pattern has played out before. Number 1. 2017 bull market. In late 2017, Bitcoin reached an all-time high of nearly $20,000. Retail investors, driven by FOMO, rushed into the market, hoping to capitalize on the gains. But by early 2018, the market had turned, and Bitcoin's price began to decline. Many of those same retail investors who had bought in at the top panicked and sold at a loss as prices dropped. Number 2. 2018 bear market. As Bitcoin's price fell throughout 2018, retail interest waned. The market entered a prolonged bear market, with prices eventually bottoming out around $3,000. But during this time, institutional interest in Bitcoin began to grow. Whales and institutional investors saw the lower prices as an opportunity to accumulate, positioning themselves for the next bull run. Number 3. 2021 bull market. By late 2020, Bitcoin's price had started to recover, and by 2021, it had reached new all-time highs, surpassing $60,000. Once again, retail investors rushed into the market, hoping to catch the wave. But as the market became overheated, prices eventually corrected, leading to a sharp decline in mid-2021. So how can you, as an individual investor, avoid falling into the same trap as so many retail traders? The key is to take a more strategic, long-term approach. Here are a few tips. Number 1, have a clear strategy. Before you enter the market, have a clear strategy in place. Know your risk tolerance, set realistic goals, and stick to your plan, even when the market gets volatile. Number 2, focus on the long term. Cryptocurrency is a long-term game. Don't try to time the market. Instead, focus on holding your positions through the ups and downs. Over time, the market tends to reward those who stay the course. Number 3, manage your emotions. One of the biggest challenges in investing is managing your emotions. It's easy to get caught up in the excitement of a bull market or the fear of a bear market. But successful investors remain disciplined and stick to their strategy, regardless of market sentiment. Number 4, accumulate. During dips, rather than panic selling during downturns, look at price dips as an opportunity to accumulate more Bitcoin. History has shown that those who buy during bear markets often see the best returns when the market recovers. Number 5, diversify your portfolio. While Bitcoin is a popular choice for many investors, it's important to diversify your portfolio. Consider other cryptocurrencies, as well as traditional assets, to spread your risk. Will the cycle repeat? As we look ahead to the future, it's likely that we'll see this cycle play out again. Bitcoin's price may continue to rise, attracting more retail investors, but eventually the market will correct. The question is, will you be ready? If you take the lessons from this video to heart, you'll be better positioned to navigate the market's ups and downs. Remember, success in cryptocurrency isn't about timing the market. It's about time in the market. Stay patient, stay disciplined, and focus on the long term. In conclusion, the recent resurgence of retail investors in the Bitcoin market is both exciting and concerning. While it's great to see more people entering the space, it's important that they don't make the same mistakes as in previous cycles. The key to success in cryptocurrency is not timing the market, but rather time in the market. If you found this video helpful, don't forget to like, subscribe, and share it with anyone who's thinking about diving into the crypto space. The more knowledge we share, the better decisions we can all make. And if you're feeling optimistic about the future of crypto, hit that like button to bring some good vibes and blessings for your financial future. I hope you all have a fantastic day wherever you are, and I'll see you in the next video. Stay patient, stay smart, and take care, everyone.